Hey everyone, it's Alex Morkay with realestateshorts.com. Today we're going to cover the topic of the debt service coverage ratio. We're going to describe what it is, how it's calculated, how it's applied, and some important considerations to keep in mind as either lenders use it or borrowers use it to help make either lending or investment decisions. Let's get into it. All right, so let's start off with first defining what it is, and then we'll get into how it's calculated. So as the name would imply, debt service coverage ratio is a ratio, it's a relationship between the total amount of net operating income that a property generates and the annual debt service obligation that that borrower of that property has to its lender. So as an example, if a property earns $80,000 worth of net operating income and it owes $60,000 worth of cumulative mortgage payments or annual debt service, the ratio between the two is $80,000 divided by $60,000, and that would help define that relationship, that coverage. So how much extra income coverage do you have relative to the amount of annual debt service or mortgage payment obligation? So in this case, it's 1.33. So as these variables change, so if anything, we'll keep the annual debt service constant. As the NOI changes, you can see how this ratio will go up and down and what that may mean to a lender. So let's say, for argument's sake, the NOI goes down to $70,000. Now you have less coverage. Whereas before you had 1.33, now you have 1.17. You don't have as much income to cover that annual debt service. And so from the lender's perspective, they're looking for something between 1.1 and 1.3, 1.1 being the bare minimum, likely associated with some kind of public subsidy or public funding, something where the government may serve as a backstop to that income as a source of protection and guarantee. At the opposite end of the spectrum, you could have traditional commercial real estate, or maybe even slightly more risky commercial real estate, or non-traditional commercial real estate. Call it like a marina, call it sometimes like a limited service or boutique hotel. It's possible for you to push up into a higher coverage amount so that the lender requires the property to generate more income relative to every payment obligation or debt service amount. So again, just to illustrate the point, what if your lender came back and said you needed to have 1.5 times coverage? You would have to earn $90,000 versus the original 80 or something less. And so it's always going to be represented as a decimal. So one time would be 1.00, or 1.2 times would be 1.20. In any event, what we're really looking for is anything over 1, because confirming that you have enough income to satisfy that debt service is going to be the first step, both for you as a borrower and for the lender. Thereafter, we get into considerations of loan type, loan terms, definition of income, which we'll get to in a moment, so that you can get as close to that lender's requirement as possible. So this is really applied in two main circumstances. The first is going to be from the lender's perspective. They're going to use this as a tool to help push terms or dictate terms to a potential borrower. So they will tell the borrower, this is how much income you've told me you've collected. As a result, this is how much money I can give you based on the debt service that we are estimating for this property and my required debt service coverage. So the lender, if they feel very comfortable with the borrower, very comfortable with the market, very comfortable with the property, they may require a lower debt service coverage. They're not going to require as much income to cover. And I think the real rationale here is, what happens if you lose a tenant? What happens if the market fundamentals begin to deteriorate? What happens if operating expenses increase and net operating income declines? They need to make sure that there's a buffer or a cushion or a safety net to make sure that as income potentially declines, there's still enough there to satisfy the loan payments. So that's from the lender's perspective. Now, from the borrower's perspective, although a bit more complicated, it's just as valuable. Borrowers can use an understanding of the market's debt service coverage requirements to help estimate how much they think they can borrow. So you can almost work backwards in the same way that some lenders are moving forwards. You could say, I know how much income I have. I believe I know the terms of the loan that I can get in the market, and I believe I know the required debt service that a lender would have of me. Given these assumptions, I can estimate how much debt service I would have, and therefore I can estimate how much loan balance I can afford or borrow. So again, let's take a look at these two in comparison. So the first is from the lender's perspective. If the property generates $80,000 worth of income and there's $60,000 worth of annual debt service, then you'll have 1.33 debt service coverage ratio. So 80,000 divided by 60,000 bucks. If income declines, this number will also go down. So 75,000 will result in 1.25. Now let's take a look at it from the borrower or buyer's perspective. The same 80,000 bucks. However, now we're going to introduce some loan terms to help us estimate that maximum loan balance. So how did we arrive at that maximum year one debt service? So the maximum amount of annualized payments you would be able to afford. So we could again work backwards. We could say $80,000 worth of net operating income divided by that debt service coverage ratio. So this would help limit or establish a maximum of what you could afford based on the lender's requirement. So 80,000 divided by 1.20 is going to give us $66,000 worth of maximum affordable annual debt service. Now, the trick here is to keep in mind that once you've calculated a payment and you have other loan terms, interest rate, term, future value, you can use time value of money principles to help estimate present value. In this case, present value being the loan amount or principal amount you can borrow. And so in this case, that's really what we're doing. We're saying, let's use the present value function, PV function. Let's take the interest rate, let's take the term. We've calculated the payment just now via that debt service coverage ratio relationship. And then let's estimate present value as a result. So we'll take our annualized interest rate and divide by 12. We'll take our term, multiply by 12. We'll take our annual debt service, in this case, that's $66,000. We'll divide by 12, because remember, that's an annual number. We need to turn this into a monthly figure. And then 0 for the future value, assuming it's an amortizing loan. When we press enter, we'll get the maximum amount we think we can borrow, a hair under $1 million. And so both parties can use their understanding of debt service coverage to help estimate either the total amount of payment a party can afford or the total amount of loan a party can afford. So some important considerations to keep in mind. The first and probably most important is that every lender is likely going to have a different definition of net operating income, of the numerator of this ratio. So let's say, for example, the lender acknowledges that you do have $80,000 worth of income. However, what if they want you to have a reserve of some kind? Let's say the roof is in tough shape or one of the mechanical systems is in tough shape. They may want you to set aside some money so that every year you can build up, call it a savings account, a reserve account, to help meet that future expense. So in doing so, they're effectively reducing net operating income, and they may use that reduced lower income estimate to help calculate or at least satisfy the debt service coverage requirement. Another great context of this is in a property that's mostly vacant or not even built. So let's take a look at construction as an example. The lender would likely impose a minimum debt service coverage requirement within a certain amount of time upon completion. So let's say it takes you 12 months to build a property. The lender is going to understand that you may not be 100% occupied day one. So they could come back and say, the lender would like the borrower to meet a 1.2 or 1.25 coverage within the first, let's say, 6 months, 12 months, 18 months of completion of the property. And they're going to ask for periodic checks and reports just to make sure that occupancy is increasing, income is increasing, so that the debt service coverage requirement can eventually be met. Just keep in mind, banks are just as flexible around this process as you would like them to be. This is a process that you can negotiate around. And so whether it be the definition of net operating income, whether it be how much time you have to arrive at the required debt service coverage ratio, there's a lot of different ways to help satisfy the bank while also it meeting or exceeding your investment expectations. So with this, we'll start to wind down. So just as a recap, we covered the definition of debt service coverage ratio. We spoke about how it gets applied and calculated, and some important considerations at the end relative to the definition of income used or the flexibility under certain circumstances that some lenders may have. So that does it for this episode of Real Estate Shorts. Here are some related videos that I think would be helpful if you found this one valuable. And as always, if you have any questions, comments, or feedback, I look forward to hearing from you. Talk to you soon.